if you're young, if you've got access to cheap rental conditions, whether that's share housing or still living with the parents, from the affordability front, they really just don't compare, because the biggest challenge that you have is, the rent that you're paying versus the mortgage that you're paying. They're not compared like for like, even if they are the same dollar amount per month. The mortgage commitment on the owner-occupied property ultimately ends up being far more than the equivalent rental payment by bank calculation. So it makes a massive difference for sure.
Hello and welcome. You're listening to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice and abundance. Today, I'm joined by a very, very special guest, Callum Rhodes, and today we're going to tackle one of the biggest questions or the biggest obstacles people are finding in building their property portfolio at the moment. That is how to get credit, how to increase your borrowing capacity so that you can get in to some really, really good properties. But first up, Callum, how are you?
I'm great, Emil. How are you going today?
Yeah, very well, thanks. Just to kick off with, so that people can get to know you a little bit, do you want to tell us a little bit about yourself and Babylon Advisory?
Yeah, no problems, Emil. Well, first of all, thanks for having me on. So, a little bit about myself. I am the CEO and founder of Babylon Advisory. So we're a mortgage broking business specifically targeted at serious property investors. So our business has kind of been born from a space of appreciating the struggles that property investors have in getting their hands on debt, because ultimately that's the part of the equation that allows you to have the greatest success. If you can't get the money, you can't buy the property. And it's really evolved into us providing creative strategies for our clients to really foster that ambition that they have to grow a property portfolio and come up with creative ways to help them do it.
That's a very, very important part of the market that I think you're servicing really, really well, because the reason I say that is because so often people have trouble getting credit, getting access to debt, and the banks are sort of like, oh no, too complex, or no, you don't have enough of this, or you don't have enough of that, not enough capital, not enough cash flow. Having someone with your expertise that can find the creative solutions and find a way for people to get access to the credit so that they can get into their next property, whether it's their first property, their first investment property, or further down the line, that is absolutely critical. And in my mind, it's a very underserviced part of the market. The vast majority of mortgage brokers that I speak to and have spoken to throughout my career, normally once they reach a certain size, it's like they just want the easy deals. They just want the easy ones that are going to be easy to get over the line, fill out a few forms. But what I really appreciate, and at Dashdot, we definitely appreciate this a lot about what you do, is take on the tricky ones and find a way. We've got to get finance for this person so that they can achieve their dreams through property. So, and what about personally? Where are you at personally these days, Callum?
Yeah, so I love endurance sports, riding to CrossFit, running marathons. I like to really push myself in my personal life, I suppose, as hard as I do in my business life. I feel like there's a good alignment between those two things. So that's probably my main interests. Okay,
awesome. All right, well, let's jump into it then, because we do have some big questions that we need to tackle. Now, I've heard, when I say I've heard, we did have a prep chat to talk about what we're going to talk on this podcast, and you told me that lending has changed a little bit recently. There are some updates that can have a big effect on people's ability to get credit and can affect their whole portfolio. Do you want to run us through what those are?
Yeah, so particularly for property investors, we really have seen in the last 6 to 12 months a dramatic increase in the LVRs possible for investment lending. So it used to be very much the case that the maximum you would get would be a 90% LVR loan for investment properties. Which by the time you've included costs, stamp duty, all the rest of it, you're talking more like a 14 to 18% deposit, depending on the state. Now we've seen lenders like ANZ, rolling out 97% LVR investment lending at really competitive interest rates. Commonwealth Bank have jumped up to 95% LVR. So there really has been a response from the lenders on the product front to try and meet the demand at the moment, because you've got a lot of, very ambitious young property investors in the market at the moment, but the capital restraint is always there, especially with stamp duty considered. So, the product front has been massive in that regard in terms of helping people with smaller capital contributions get in the market.
So essentially what you're telling me is for a lot of people, you can actually get into a property these days with a deposit as little as 3%.
Yeah, 3% plus cost, which might end up being, 10%. And it used to really be the domain of non-bank lenders, with much higher interest rates offer these super high LVR lending restraints. But and you're sort of pairing that with, at the moment, the general credit approach from most banks is The hurdles are pretty high that you have to jump through just from an affordability perspective, the interest rates being so high. But once you can get over that hurdle and meet the bank's income requirements, we're finding that credit is flowing pretty freely at the moment for property investors, even at very high LVRs.
I have a theory on why that might be. And this sort of digs into a fairly big topic of the government needs money at the moment. And when the government needs money, the way they get money, well, they can't increase taxes because they've announced that they're going to be reducing taxes. And so the government needs to issue bonds. As they issue bonds, the banks need to buy them. In order for the banks to buy them, the bank needs cash. How does the bank create cash? By writing loans. So my normal barometer for trying to predict, and that's what's great about podcasts, right? This one's going to be around forever, so people can check in 12 months if I'm right or full of crap, is that this year is going to be a massive year for property because the government needs money. And when the government needs money, they relax the lending conditions and make it easier for people to get a loan. And so I think that's what we're seeing this year. And we were looking at a lot of info. A lot of economists at the moment are reporting that interest rates are going to be due to fall in the second half of this year and throughout 2025. I don't know if they're right, but it feels like they're trying to get the messaging out there that lending is going to be they're trying to give themselves, they're trying to pre-frame an excuse for reducing the interest rates because we've got inflation under control. I don't know if we've got inflation under control or not, but what I do feel is that the interest rates are going to come down. And as that happens, people's plus tax changes that are coming up, plus the LVR changes, it's going to be a hell of a lot easier for people to get property in 6 months, in 12 months than it is now. And that is going to push the prices up and make them explode. Now, this is just my prediction. This is not financial advice or anything like that. So it really makes it important, if you want to make the most of that you can get in now. So in terms of how difficult is it to get credit, it's as simple as contact Callum. He'll help you out. You can, get an assessment of your situation. Are there a lot of hurdles in place at the moment?
So in terms of the current environment, even if we sort of juxtapose that with, even 2 or 3 years ago, the availability of credits, it's easier right now than it was 2 or 3 years ago. Easier in the sense that the bank is more willing to give it. And in terms of the verification from the bank, we've seen them really relaxing on living expenses as well, which used to be a bit of a sore point a few years ago. So the only hurdle you really have to jump over is the affordability margin of interest rates being high. But apart from that, it's an easy time to get credit. And I think just going back to your point about, banks needing to lend money, I think we're also seeing on the product front from the banks with the high LVR investment lending, you've got a lot of young purchasers out there that the serviceability isn't there for them to be able to purchase owner-occupied properties at the moment. So you're seeing a fair chunk of that younger cohort, first home buyers moving towards the rentvesting route and perhaps using that $50,000 or $60,000 of deposit that maybe a few years ago they would have gone out and purchased the first home. The affordability often just isn't there, so they're instead being funneled towards that rentvesting low deposit investment property type purchase.
Okay. That's an interesting topic, rentvesting. We've talked about it on quite a few of the podcasts. It seems to be a really popular thing. And I know from our strategists that it can be an extremely effective way of accelerating your portfolio because you don't end up getting tied up with all of the affordability constraints of having your own home and the way the cash flow around having your own home gets assessed by the lenders. What are your kind of feelings on rentvesting as a strategy?
Yeah, definitely. I think it's a fantastic strategy. If you're young, if you've got access to cheap rental conditions, whether that's share housing or still living with the parents, from the affordability front, they really just don't compare because the biggest challenge that you have is, the rent that you're paying versus the mortgage that you're paying. They're not compared like for like, even if they are the same dollar amount per month. The mortgage commitment on the owner-occupied property ultimately ends up being far more than the equivalent rental payment by bank calculation. So it makes a massive difference for sure.
So, for example, if a family of 4 or a family of 3 is renting a property for $500 a week versus owning a property with a mortgage payment, and the mortgage payment is approximately $500 a week, can you break it down sort of how differently the banks or the lenders would assess that?
Yeah, so the rental repayment is just treated at dollar value by the lender. There's no buffering applied to that. But the mortgage repayment, they're going to add their sensitivity margin to that, so that's 3%. So that gets added on top of the loan. So then effectively what ends up happening is that $500,000 repayment turns into more like an $500 per week repayment turns into more like an $800 per week repayment in their assessment. So that's where the big difference comes into it. And then the other thing as well is, from a living expenses perspective, it can work out worse as well, because you've got to include all the upkeep of that owner-occupied property, which is another aspect that people often perhaps don't include in their calculations. The maintenance, the repairs, all the other stuff that comes with an owner-occupied property versus being a renter.
I didn't realize the numbers were that big. 500 versus 800. So if you've got enough cash flow from working what could be a fairly normal sort of a job, if you get into an investment property first, your cash flow is going to get assessed at $500. It's going to get assessed at whatever the rent is. If you have gone and bought your own home, then it could be $300, could be thousands of dollars a month more that you get assessed on, which then makes it really hard to get into your next investment property, which might even be your first investment property. We've talked about that a lot in different podcasts, where it can actually stop someone's entire portfolio growth. It can just ruin the whole thing. They can get locked up. They can get completely stuck. And they have to save up for a couple of years, like 3, 4, 5 years, in order to get enough of a deposit to make sure that the lenders are going to be happy to get into just their first investment property. And so sometimes
I call it the keeping up with the Joneses trap around here, because that's often what it is. The price of the owner-occupied property just goes up and up and up and up, and maybe you didn't need to spend that extra $200,000 on the owner-occupied property that's potentially held you back from, investing further in property, whether that's 2 or 3 more investment properties.
Right. Okay. All right. Well, the big question, a lot of people listening to this may well be wondering what strategies are available to get access to enough credit to get into properties in probably the 400K plus range. The reason that the 400K plus range is important is because, for the last several years, we've been looking at properties in the 250 plus range. But as prices have just gone up and up and up and up, there does seem to be a really good portion of the market at the 400K plus mark that looks like it's absolutely primed for growth. And so a lot of people are looking at those at the moment thinking that's where I want to be. Those are the properties that I want to get. Sort of any tips, tricks, strategies that you have where people can get into those with servicing and et cetera?
Yeah, so the first big one that we're seeing at the moment, especially this is applicable if you're an existing property owner, we're seeing from a lot of the banks, for whatever reason, their internal valuation systems or their desktop valuation systems are quite often valuing properties substantially above market value. Especially Commonwealth Bank in particular. So the first thing we're seeing at the moment is the ability for people to access equity in properties that they own that perhaps by a true market analysis isn't actually there. So the banks are really allowing themselves to be overexposed to you gathering further equity to put towards another purchase. Very common scenario, probably 2 or 3 times a week, we're funneling transactions specifically to lenders just because we know that their valuations are above market. So that'll be tip number 1, play the game of desktop valuations versus, short form valuations on market. And then let's imagine that, that increased valuation on your existing property allows you to access, an extra 5 or 10% equity. If you compare that with the high LVR lending strategies that we're seeing from the likes of ANZ and Commonwealth Bank, all of a sudden, that $50,000 deposit that you're able to gather from the equity in your property from that increased valuation, that's easily enough of a deposit for you to be purchasing in that $400,000 to $450,000 price point.
We did have a great case of this. One of our clients, they bought a property for in the 400 to 500 range, got it revalued a number of months later, around 12 months later, and suddenly it's valued in. They did a little bit of improvement to it, but the desktop val came in at 700. And the member I spoke to, he said, it's not worth 700, but the desktop val came in at that. It allowed the client to pull some equity out and get their portfolio moving. And you only need 1 or 2. Would you call them mistakes by the bank? You just need 1 or 2 opportune moments where the bank may be valuing the property higher than what the market might be. You only need 1 or 2 of those little opportunities to pop along, and it really can forge up a great portfolio.
Definitely. I, to be honest with you, I'm not sure it's actually a mistake. I'm not going to cast aspersions, but it may be a deliberate strategy by some lenders, I believe, but yeah, just mirroring what you said. We had a young guy purchase an investment property down in Tasmania about 2 months ago, and we literally valued the property 1 month after settlement, and had gone up in value 15% on paper, and he was purchasing another property straight away. Like nothing had been done to the property. It was sold under market conditions. For all intents and purposes, it was worth what he paid for it. But it's just the things you've got to take advantage of at the moment, pairing that with high LVR lending.
So it does sound like it's a very buyer-friendly and lending environment that we're in at the moment.
Certainly. Absolutely.
Any other tips, tricks, techniques, strategies that people can use to access more credit?
Yeah, so the other one, which we see a bit of from more serious property investors now, of course, general advice disclaimer here, you need to speak to your accountant and financial planner before you go and undertake anything like this. But we're definitely seeing a rise in the prevalence of people purchasing properties outside of their personal name, whether that be in trusts or companies. So the strategy centers around owning assets outside of your personal name that are cash flow positive. And what this strategy essentially allows you to do is that provided you've got property assets owned in a trust, let's call it, and it's looking after itself, it's cash flow positive. There's certain lenders out there where if you're going to fund a subsequent transaction after that, that debt position is excluded from borrowing power calculations altogether. So what that essentially means is it's like hitting the reset button on your borrowing power. So your borrowing power can essentially be the same today as it was, even though you've purchased the property owned outside your personal name. So that's definitely rising. That was something that was quite rare to see, even 2 years ago. But I think with a lot of the borrowing power constraints, we're seeing a lot of people getting more creative, consulting with their accountant and working out alternative structures for them to continue purchasing property. We're also seeing a bit of a rise in self-managed super fund lending for that reason as well. People maxed out in their personal name and looking for alternative vehicles where they can fund property to continue growing their property portfolio.
Okay. So what you just said there, as long as you put things not necessarily in your personal name, but in a company or a trust, and again, talk to your accountant first, essentially people are generally at they have the best borrowing capacity when they don't own any property, when they don't have any debt. And that's when the bank will lend you probably the most that they ever will. And then with each subsequent property that you acquire in your personal name, your borrowing capacity, the calculation means that it's gradually always coming down. But if the investment properties that you're purchasing are in trusts or bought as companies, then the bank or some specific lenders don't actually look at those. And so it's like hitting the reset and getting back to the really high borrowing capacity that you might have before you buy your first property.
Exactly, because the challenge with if you have a super high yielding property, let's say even if it's got a 9% yield purchase in some regional location in your personal name, what most banks are capping the rental yield at 6%. So all of a sudden, you're losing 30% of the rent straight off the top. And then by the time they've done that and then added 3% to the interest rate you're paying on that loan, even though that property is putting quite a lot of money in your pocket each month, by a normal bank assessment, it's not. So that's why there's no infinite borrowing power for purchasing super high yielding cash flow properties when they're purchased in your personal name.
So even if you're looking at a property, it looks like it's really awesome in terms of cash flow. It's going to put thousands of dollars into my wallet each week. The bank will not assess it that way. The bank can assess it as no, we're not really counting that. Plus, we need to put a margin on for as their security. And on paper, it can reduce your borrowing capacity, even though the property is putting thousands and thousands and thousands of dollars in your wallet every month. That is pretty important. It does feel like there is a massive gap between the way the banks assess all of this stuff and the way the market assesses properties and yields, etc. And so the trick, and where your expertise really comes to the fore, is knowing what that gap is, so that people can end up with an optimum result. Okay, there's any other tips, strategies where people can get into more of these properties?
Yeah, so the other thing we're seeing fair rise on is people looking to implement dual occupancy strategies, or strategies such as granny flats. That's definitely a flavour of the month at the moment. A lot of clients undertaking those sort of strategies to boost rental yields. But again, the challenge with that is you're still capped by that 6% rental yield, and sometimes I look at those deals people are doing and wonder about the return on equity of the capital that they're having to invest into it. But that's certainly something that we're seeing a lot more of at the moment as well.
That rental cap that you mentioned of the 6%, that's what most lenders or all lenders are looking at as the maximum yield that they will use in their calculations?
Yeah, so amongst the major banks and their subsidiaries, basically all of them are capped at 6%. You know, the likes of Macquarie and Bankwest aren't. So looking across the market, you know, probably 80% of all lenders are capped at 6%.
So if I have a property that's yielding 7.5%, putting thousands of dollars into my wallet, into my bank account every month, the bank is only going to look at it, if it's in my personal name, the bank will only look at it at 6%. Plus, they'll put on a 3%, their 3% security on top of that. And so they will assess it. That's pretty different from the reality, isn't it?
Yeah, absolutely. I mean, you can understand why they build these sensitivity margins in, but I think the challenge on the product front, and also it's the APRA mandate that allows that, you know, the banks don't have any freedom with this and sort of instruct that's what they have to do. But the challenge of that sort of model is that it's really not conducive for serious property investment without some creativity, because, you know, oftentimes you have investors out there that are in fantastic cash flow positions. You know, maybe they've got a variety of high yielding properties. But the challenge is that, you know, the affordability just isn't there unless the debt is structured in such a way to allow them to continue. I've got clients very active clients of mine that I've been working with for a long time that have got 15 properties, and the cash flow for them, it's more than $150,000 per year cash flow positive. But the challenge for them is all their properties are owned in personal name, and it's difficult every single time we go to fund a transaction, even though, you know, if you're an accountant or, you know, you're analysing their cash flow, like, geez, these guys are making, you know, a really good solid income from investing in property, but by bank calculations without the right structure, it's really tricky.
Okay. So if we go back to that example that I quite like, if the property is yielding 9% or 7.5% or something like that, the bank will only assess it at 6% yield. And then if the mortgage on it is 5%, they will add 3%, which says 8% in payments you need to be making, but you're only yielding 6%. That's negative cash flow. And so that is going to restrict your borrowing capacity. Whereas if you buy it, again, not financial advice, if you buy that property in a trust or in a company, then the bank will say, what's the actual cash flow? That's more than the mortgage. Okay, cash flow positive. Don't need to think about it. And it becomes neutral in terms of your borrowing capacity for other properties. Exactly.
Yeah. That's
that kind of sounds like a great strategy would be to rentvest. Rent somewhere nice-ish, buy an investment property in a trust, and just keep on buying those until such time as you've got so much that you can get your dream home.
Yeah, I mean, if I was mirroring the way that I personally invest in property, it's exactly like what you just mentioned there. And if I was a young property investor out there, you know, obviously seeking the right advice on structuring it and whether you should be doing that. But it's certainly a strategy that does allow you to scale a property portfolio far quicker than, purchasing a couple of properties in your personal name. Because the reality of it is, for most people, unless they're, you know, on very high income levels, you know, they're, you know, a doctor or a solicitor or something like that, even if you're purchasing assets that yield fantastic cash flow, there really is a limit on the amount of total debt you can get your hands on without massive personal income levels.
Okay. Are you having many people come to you where they might not have the capital themselves to get started, but there's equity in their parents' home, grandparents' home, relatives' homes, and things like that, where they're allowed to access that?
Yeah, that's another good point. So I suppose the joint venture type deals at the moment are certainly on the rise as well, for those reasons that you mentioned. Could be a capital constraint or a borrowing power constraint. Now, you do run into challenges if you're trying to access equity out of someone's property that's not your spouse, for example. So let's say, you know, you and I, Emil, we decide we want to go out there and purchase an investment property together, and you own a property that's got some equity in it. The difficulty comes in accessing that equity, because there's no way that I can become a party to the loan on your property because we're not spouses. So that's always one challenge that comes with it. But provided the capital is available, that's certainly a strategy that you can use to boost your total borrowing power, you know, combining two incomes together towards purchasing one asset. But the only hesitation that I'd place on that, which, it's a very common scenario. I had one just last month where if you purchase properties with parties that aren't your spouse, and then you go to purchase property in future transactions, it can really be prohibitive towards your overall borrowing power. So let's go back to that example of you and I, Emil. Let's say we purchase this investment property together. We take that loan together. Then after the fact, you decide you want to purchase another investment property by yourself. What most banks will do is they'll require you to include the full debt that you've got on that property with me, and they'll only give you half of the rental income that you're receiving for that property. So what ends up happening is your borrowing power gets destroyed by that shared debt that you have with someone else, with basically all lenders. So whilst it is a good strategy that, people can be a little bit short-sighted and implement on their next property purchase, I'd caution it from a long-term perspective in terms of building a big property portfolio.
What about, or does the same apply if it's parents, grandparents, brothers, sisters, that sort of thing?
It's all exactly the same. So if you go borrowing a loan, it's a difficulty that you'll face. But using parents, brothers, sisters, and so forth, what you're perhaps alluding to there is a guarantor loan. So that's the scenario where if you don't have any capital available, someone in your direct family can put their property up as security to allow you to purchase properties. Now, it's usually a product that most young first home buyers might be familiar with to buy a house to live in, very common to that, but there's actually quite a range of lenders that will allow you to use someone in your direct family's property as security for you to be able to purchase an investment property without any deposit at all. So there's definitely been a rise in that compared to a few years ago as well.
Okay. All right. And we talked about desktop valuations a little bit before. How do you see the future of valuations over the course of the next year? Do you think they're going to keep on being fairly loose, or do you think banks are going to tighten them up? Any prediction?
I think they'll keep getting even looser, to be honest. What you've seen is the banks have been trying to shed costs on the valuation front as well. So it used to be more common for banks to actually instruct a valuer and send them out there to complete the task. But, they've all got more sophisticated internal data systems now that they've been able to shed that cost. And I think given that they've built these platforms, it also allows them to potentially tweak what their valuation system looks like depending on the credit appetite and where they want to lend money as well. So I think we'll continue to see the market moving away from third-party valuers and moving towards internal valuations.
That's the phrase. I'm going to use that, credit appetite. What is the credit appetite for the banks? How much money do they want to be lending out, or how much money have they been tapped on the shoulder and told that they need to lend out so that they can buy bonds?
Yes, exactly.
That's the whole property game.
Pretty much.
All right. Any other final thoughts or ideas that you want to leave with us today?
So I suppose just mirroring your thoughts on, the overall interest rate market and, and what the outlook looks like. I think far be it from the doom and gloom that we see in the media. I'm seeing active property investors at the moment. They're still purchasing great off-market deals. They're still getting their foot on good assets that I think have good prospects for the future. So I think if you pay attention to the doom and gloom approach in the media, you're ultimately, it's going to be actually detriment. I'm seeing great buying conditions out there and, great outlook for the next few months. So the action takers at the moment, they're the same clients that in 12 months' time, I'm going to be speaking to them to purchase the second, the third, or the fourth property because they're the ones out there doing the work.
My strong views that I've sort of talked about on numerous other episodes has been the property market is just going to keep on going up and up and up because the government needs money. And I see house prices continuing to go up in dollar terms a lot over the course of the next year and the years beyond. And there is a little bit of a worry in the back of my mind about those that don't jump on soon enough. Are we going to reach a point where, we've talked about $250,000 properties, we've talked about $400,000 properties. In a year, we'll be talking about, in order to get into the market, you really need to be looking at the 500K plus and the 600K plus and the 700K plus markets in subsequent years, because it feels like it may well move that fast. And so I feel like there may be an increasing divide between people who are able to get into the market and people who can't. And my strong belief is that people in Australia, the way the economy is set up, the way the financial system is set up, the way the property market is set up, is that basically your ability to become wealthy comes down to your ability to get credit. If you can get credit and you know to invest in property, then you're pretty much going to be okay. If you can't get the credit, and this is why your expertise is so valuable, because you can help people get the credit that they need. If they don't, they just go to the bank, use normal channels and things like that, they might get the door slammed in their face. But it's the creative solutions. It's finding a way to get the credit at what I think is a pretty critical time, because, you do have those European countries where the same properties have been in the same family rented out for hundreds of years, and you can have a very strong have and have not divide. And in the States, New Zealand, Australia, we've very much had more of an Aussie dream, where you get to own your own house, you can get to be wealthy, but it all comes down to your ability to get credit. If you can't get credit, it's very, very difficult to save your way to wealth. In fact, I would say it's probably impossible. If you can get access to credit, then you can end up investing in property that's going to outperform inflation, and you can be one of the haves and not the have-nots. Now, that's my personal take, which is probably a little bit of a wind-up for our episode today. And I guess we'll get to see, in 12 months, 18 months, how close we got. Do you have any feelings on my views there?
Yeah, no, I think, all the recent inflation that we've had is realistically all it's done is, further made that division between the haves and the have-nots. And it's only going to continue as far as I see it. So definitely mirroring your thoughts there.
Okay. You don't have to if you disagree. Now's the time. This is on record.
No, I like your view. I'm not just going to agree with you for the sake of it, but no, I do agree with you on that case.
Well, on that note, I think we've got some really, really important takeaways out of this. First up, the lending environment is really, really changing a lot, and people are finding it a lot easier to get credit. Nevertheless, there are very, very important strategies that are out there that people need to utilize efficiently to make sure that their portfolio growth is exactly where they want it. And step one for doing that is probably to talk to a mortgage broker such as yourself, so that at least they know where the goalposts are, and they know what the most efficient route to get there is. And it can be, as we've talked on other episodes, it can be the difference between getting to your goals in 5 to 10 years versus 30 years or never. That's how important. I mean, it kind of feels like it's admin, working out where the gaps are between the way the banks are going to treat a portfolio under this structure versus this structure. And the intel, the knowledge of the different ways the banks are going to assess stuff. To me, it seems crazy that they assess it so differently from reality. But, I mean, it's an incredibly important skill set that you have in being able to navigate that and point people in the right direction. So, thank you very much.
Thanks, Phil. Thanks for having me. It's been great. Really enjoyed the podcast.
Thank you very much. Cheers.
Bye-bye.